investment that falls into this last bucket is an investment you must reject. The 4 buckets behind me represents 4 different types of investments, and at the end of this video you are going to know how to analyze your investments. This fourth one is not really an investment, and that's where some people put in their money thinking they are investing their money, and at the end they get nothing out of it. Even if they get, it is a speculation. It is not really an investment that you should bank on. So we are going to treat it last, but quickly let's look at these 3 buckets, and I'm going to be giving you examples of each bucket, how you can analyze your investments whenever you want to invest. So in the first bucket, we call it the cash flow bucket. I need to say this, that we invest majorly for 2 reasons. We call it the 2 C's of investment. Number 1 is for cash flow. Number 2 is for capital appreciation. Cash flow or capital appreciation. The third bucket is called both, and I'll be giving you examples. So when you are investing your money, you know what exactly are you investing for. Are you investing for cash flow, or you are investing for capital appreciation, or you are investing for both? So when I give you the examples, you will understand more. For instance, if you are investing only for cash flow, which means when you put in, let's say 100,000 at maybe 20%, the 20% is what you'll be collecting in form of cash flow. Maybe it could be quarterly, it could be quarterly, it could be annually, it could be semi-annually. So it is in form of cash flow, or at times you may even do some, it may be monthly. I hope you understand. So, but the matter is, your 100,000 naira does not appreciate, does not suddenly becomes 150,000. No. What you have is cash flow. For instance, treasury bills is meant to give you cash flow. It's only that the cash flow from treasury bills is always at the beginning. It is once. Except you are now investing monthly. Maybe you are doing compound investment. You are putting in money into treasury bills every month. Since it is being offered twice in a month, and if you want to use the apps, you can do it whenever you like. Now, FGM bonds is also for cash flow. Nothing happens to your capital. It does not appreciate, which means it does not increase in value. So you collect your money quarterly here, every 3 months. That's when you collect your money. So it is for cash flow, not for capital appreciation, because your capital is still the same. It's still 100,000. Mutual funds as well. Nothing happens to your capital. You only have cash flow. Commercial paper, that's the example of cash flow. So when you want to invest, ask yourself, is it for cash flow of capital appreciation, or for both? Now let's move to capital appreciation. What is capital appreciation? Capital appreciation means when you put in this 100,000, there's no interest that accrues to you annually, semi-annually, or quarterly, or monthly. There's no interest. The only thing that you have is suddenly your 100,000 naira may become 150,000, may become 200,000, depending on the return on investments. Such is, for instance, when you buy commodities. When we say commodities, we mean something like you buy an artifact, you buy baseball card. It's not so common in this part of the world, but we have commodities like that. So the next one is land banking. So when you buy commodities, when you buy baseball card, for instance, and you have it, before you know it, it appreciates in value. Land banking, when you buy a piece of land for, let's say, 100,000, suddenly the land in the next 2 years now becomes 200,000. So that is an appreciation of what? Of 100,000. By the time you now sell it, that is when you have something called capital gain. It is called unrealized profits. It is unearned income. We call it gain on paper. So even though it is your 100,000 naira that you invested in land banking or in commodities, it is now 200,000. But the matter is, you don't have it in cash. You only have it in form of land or in form of commodity until you sell it. So what we call that is capital gain, unrealized gain. It is a gain on paper. Until you sell it, that is when you now have your cash. So suddenly your 100,000 has now become 200,000. That is 100% return. 100% return on investment. So that is capital appreciation. It means you are not having cash flow. What you are having is capital appreciation. Then you have digital assets. Digital assets. For instance, when you buy coins, you buy token, you buy crypto, those ones, blockchain technology, those ones are digital assets. A coin suddenly appreciates, you buy Bitcoin, you buy Ethereum, you buy any of the meme coin, and suddenly it appreciates, the price goes up. That is called capital appreciation. You don't collect cash flow from that. It is not something that you collect regularly. When you buy gold and silver and the ounce also, the price of the ounce goes up, that is in form of what? In form of capital appreciation. Then as for the third bucket, which now talks about both, that when you want both capital appreciation and you want cash flow, then the best thing is to invest in the assets or in the vehicle that will give you both. Example of such investments is when you buy shares. When you buy shares of a company, so you receive something called dividend. Some companies do semi-annually, which means twice a year. And at the end, if you are buying the shares for, let's say, 10, whether 10 naira or $10 or 10 cedis, at a point in time, as long as the company continues to grow, the shares may become 20. So this is called capital appreciation. This is called capital appreciation. The difference between them, which is now 10, you know, you bought it 10, it has now become 20, then this is called capital appreciation. So which means you have gained other 10 naira or $10. Now, don't forget that you are collecting dividend, whether semi-annually or annually. So in this case now, you have dividend and share price appreciation. In the case of shares, you have dividend and you have share price appreciation. When you see the wealthy going for shares, buying shares of companies, this is what they are looking after. This is what they are after. Another one is rental property. When you buy rental property, you collect rents. That is a form of cash flow. And the property also appreciates. Not the property in itself, but the land. According to, in our accounting, we believe that it is the land that really appreciates. So you have rents and you have the value of the property also appreciating. Then farming, for instance, if you have land, in this case now, for instance, you have land banking, you bought land here, but the land is not yielding anything. So the only thing you are expecting from it is cash, is capital appreciation. You are expecting the land to appreciate. But if you can use that same land for farming, then what happens? You are having cash flow from the farm produce by selling the farm produce, and you are also having capital appreciation from the value of the land increasing in price. Because over time, the price that you bought the land would have increased over time. It is called capital appreciation. And by the time you are selling that land, at the end, you have something called capital gain. I hope you understand. Then business as well. When you have your own business, it gives you two things. Number one, cash flow, because you are having profit, in form of income now. Then the second one is, if you manage that business well, that business grows. And when it grows, the value of that business is going up. There's a part of a business that we call intangible assets. It is called goodwill. When you want to sell such a business, for instance, they will value it. So the value of the business also goes up. That is called capital appreciation. I hope you understand. Now, let's move on to the last one. This last one, intangible investment, any investment that you cannot point to that this is what that company is doing, this is what they are into, this is how they intend to generate their return. Once you are not sure, the best thing is to run away. The scam that I said occurred at the beginning of this year, that they said people should just bring 3,007, that they will be collecting 100,000 plus. They did not specify what are they into. It is intangible. When MMM came and I was telling people, this is not investment, this is a scam. It is called pyramid scam. People thought we were joking, but eventually they lost money. You may say people cashed out, but that is not investment. That is purely scam. Robbing Peter to pay Paul. That is not an investment. That you cannot guarantee, you cannot pinpoint that this is what you are expecting in return. It is merely scam. And all this get rich quick scheme, we call it GRPS, which is get rich quick scheme. All these ones are nothing but scams. Once you cannot pinpoint what is this investment all about. When you are investing in treasury bills, you know whom you are investing with. When you invest in FGM bonds, you know who you are investing with. When you invest in mutual funds, you know whom you are investing with. When you invest in commercial paper, you know whom you are investing with. You know what they are doing with your money. At least commercial paper, you know the company, what the company is into. For instance, if BUA decides to come out, or Dangote Cement decides to come out and raise commercial paper, you know what they are into. You know what, when you are buying commodities, you are buying baseball card, you are buying artifacts, you know what you are buying. When you are buying land banking, you know what you are buying. You know you are buying tangible, and if it is financial assets, you know what you are into. But all these ones, they are nothing but scam. So you should not go for this ones. You should not go for this last one. Once you know that you cannot pinpoint, put your money in something that is tangible, something that you know it is sacrosanct. Even though there is risk involved, but at least you know that what you are putting your money into is viable. It is, the probability is high. You have minimized your risk, and you are rest assured of your return on investments. That's all I have for us on the type of investments you should reject. Reject this last bucket. It is very important. Any investment that falls into this last bucket is an investment you must reject. If you are here to watch this video on every investment is risky, I recommend you watch it. Till we meet in our next video, stay blessed.